computer. Awesome. So welcome, everybody. This is a deal presentation put on to you by the Candace Major Group. I'm going to start off the presentation, then I'm going to hand it off to our partners, Leonard and David, who are going to do the bulk of the presentation, and then I will wrap it up at the end. As always, I'm going to put my contact info into the chat. If anybody ever has any questions about this particular real estate investment or any real estate investings, please make sure that you reach out to me. Tonight, we're talking about a very exciting opportunity. So give me a thumbs up if you can see my screen. We're good. Awesome. Thank you. So this is a particular opportunity. This is Woodland Ridge Apartments. It's in Hope Mills, and Hope Mills is a suburb of Fayetteville, North Carolina, and we'll give a little bit more details about that area. I happen to know that area fairly well. It's a great area, and this particular opportunity is 60 units. It is Class B, which means it's a nicer, newer property. There are 34 units that were built in 1985, and that's the ones you'll see in the picture here. And then yes, we'll do a recording. Thank you, Darius. I'll make sure that we get that for you. And then we have 26 units that were built in 2014. This is a 506B offering. And because we're all part of the Big Dog community, that helps with the fact that we have a relationship together, because this is a closed loop group. You do not have to be an accredited investor, but if you are an accredited investor, it's always a good time to invest now, because you don't have to do all the paperwork that proves you're accredited. You can self-select that you're accredited. This is a QR code, and I'll also have a link a little bit later where you'll be able to see the deal on our cash flow portal. And this deal, of course, is co-sponsored by Massive Capital, Massive Masters, and Phil and Shinoa. You'll see there, and you'll see lots of pretty pictures of myself, because I'm vain. I like to put my pictures in the chat and different things. So this is for the Massive Masters. For those of you that don't know, we have a group that is part of the Massive Capital and Phil and Shinoa's CRE Real Estate Group, and David and Leonard are partners with us actually on another deal in Midland, Texas. They'll give a little bit talk about that, but we help people present deals. So the last couple of opportunities, so our project in Sealy, Texas, the 60 units, and our mobile home park in Ada, Oklahoma, this was all structured under a similar network. So again, I want to make sure I'm clear. Candace Major, we facilitate these presentations, but we do not endorse or vet the investors, and all investment opportunities do carry some risk. So the fact that we've pre-screened everything we present to you still doesn't mean that it's 100% risk-free. So we have lots of disclaimers. This is another one. You have to read this one in the 5 seconds. And it really says the same thing, that you must make sure that you do all of your own due diligence, and that you make sure that you ask any outside professionals if you would like to have advice. And then obviously, a little bit contradictory, because I offer a lot of the advice with the Candace Major, but I'm happy to answer your questions honestly. So at this part, I'm going to turn the presentation over to David and Leonard, and then they're going to go ahead and talk about this particular opportunity that they're doing in partnership with Massive Capital and Massive Masters.
Man, Trevor, you always get me pumped up, man. Thank you for the introduction. I appreciate it. So, we're really excited to be able to, well, first of all, we're grateful for everybody to be here tonight. We're looking forward to presenting this opportunity to you. This is actually the second deal that we've done with Massive Capital in the last 2 years. The first one we closed last August in Midland, Texas. That was 53 units. We have a very strict criteria on our underwriting, and we were offering 5.5% for the first year. But because of that, we were able to pay out 7% to all of our investors the first year. So that's very exciting. And actually the fourth distribution to all of our investors just went out yesterday. So we're very pumped about that, and looking forward to presenting this opportunity to you. So thank you again. And I'll pass it off to Leonard, give you a little introduction on him.
Hey, my name is Leonard Wote, and I'm excited to be here, and I'm so excited about this deal. So Dave, I met Dave at the conference, and we've been partnered for a while right now. So we partner with Massive Capital and closed the Westwood deal, and we also are working on this one to close this one as well. So I've been in real estate since 2015. I did some fixing and flipping on 186 properties, fixing and flipping, and then I moved to multifamily. then bought a 16 unit in Asheboro, North Carolina, 2021, with a fixed debt, not a variable debt. Then met Dave and we started doing big deals and syndicating. So I'm excited to be here and excited about this deal.
Yeah, multifamily is definitely our passion. You'll see that as we go through here. So there is going to be a lot of slides in this presentation. We're going to give you guys the real thick business and all the good information, and you'll be able to go through this yourself and do your own due diligence and take your time to skim through all the finer details. But we're going to start off right now with some of the property details. So this is 60 units, as Trevor mentioned. The average square footage for these units are 1,050 per unit. So that's a nice size for these. And we're going to be looking at some more pictures of those units in the slides ahead. 63,000 rentable space. So 36 of these units were built in 1985, and then 24 of the units were built in 2004. This is 6 buildings, 3 stories. The market rents that we're going to be showing you conservatively, $11.94 from the comps, and the in-place market rents right now at Woodland are $10.68. So you can see the delta there. That's a nice delta. We got study occupancy above 93% and above. The mechanical and construction is pretty standard. Electrical is copper wiring. We don't have any of the rag wire. The plumbing is copper pipes, no PEX pipes or any of that old stuff. Plumbing is cast iron. Heating, air conditioning, hot water is all electric. Wood framing, brick, and then siding on some of these buildings as well. Shingled roofs. So another good thing is we just had the roofs replaced on the 5 older buildings 5 years ago, and then the newer building was 2 years ago. So we do have new roofs on this property, which we were really excited about. And I think we can, yep. So we're going to start off, and you're going to see in the slides, this is what we're going to be talking about in the presentation. So some of these investment highlights. Woodland Ridge, as Trevor mentioned, is a Class B asset and a Class B location, and that's just based on the year that it was built, the quality of the units, and the location, which you'll see more in this presentation. So this, they did come out with this last year at 7.8 million. They didn't get any traction. And then Leonard and I kept letting them know that we were here. Hey, we love the deal. Let's talk. Let's negotiate. So they actually came back to us, and we were able to put this under contract for 7 million, which is 116,000 per door. And you'll see in the sale comps that we're at like 130 to just under 200,000 per door for other buildings the same year and square footage. So some of the proven value add framework, the previous owner, or current owner, I should say right now, just finished putting $1 million into interior and exterior renovations, and we'll be showing you some of those. 52 out of the 60 units have already been upgraded. So there's only 8 units left that have not been upgraded. A good thing, and what we love about this, and all the opportunities that we bring, cash flow day one. So we do not have to go in here and renovate these units in order to get the rent, get up to the market rent that we're going to be showing you in the business plan. This cash flows for everyone day one. And we are going to, when we close, we are going to, 4 of the units are vacant right now that haven't been renovated. So we're going to renovate those and start pushing those all up to market rents. The current owner just started getting those renovated units up to market rent. There's probably 5 to 10% of them that he just started doing, just to kind of justify those rent increases for the new buyers, which is going to be us. So new roofs, as I mentioned, updated HVAC systems. The occupancy has been consistently over 90%. We love that. Freddie Mac loves seeing that. A structured fee program has just been put in place by the current owners, and we're going to continue to push that as well. We'll be showing you some more about that. And of course, Woodland offers immediate value and long-term growth for all potential investors. Some of the excellent market fundamentals that we like. So the Fayetteville MSA, Metropolitan Statistical Area, continues to benefit from strong market fundamentals with a recession-resistant employment base. And so in the past 5 years, it's had what I like to call the 3 major food groups: population growth, employment growth, and rent growth. And you can see the percentage of all those in the last 5 years. This is positioned within a high demand submarket with limited supply in the pipeline for multifamily development, with only 72 units that are currently planned to be being built. So there's a high demand for rent and a low supply, which is great. We like to see that. Fort Liberty is a key economic driver in this region, and they are set to receive $84.5 million in infrastructure and personnel So that's just naturally going to stimulate the economy around this area. So we like to hear that. The investment summary, we pretty much already skimmed through that, and we'll be getting into some more of that. So 7.9% rent growth in Hope Mills. That's a nice number that we like to see.
Sorry, I
That's
went too
throughout the
fast there.
past 5 years. Nope, that's good. So some of the value upside is the average in place at Woodland, as I mentioned, are 1,062, and the market rents that we'll be showing you in the comps are 1,200 and up. But just conservatively, we like to say 1,200, so that gives a good opportunity to drive that NOI growth. The 52 out of the 60 units have already been renovated, and they just started raising the rents on those renovated units to $11.94 to help justify those rent raises. So you can see that's $132 premium above in place average rents. And so after the value add, you can see that the T1 annualized monthly NOI has grown by 5.92% compared to the T6 NOI of 10.33. So you can see the difference from 1 month to 6 months just by those rent increases on those units. The structured fee program that I mentioned has been put in place. That's just like an internet, tech, trash, pest control package. So we do have a RUBS program. So all the tenants will be paying their own utilities. We get that the utilities reimbursed, and this is a separate package, just covering cable, internet, and all the extra stuff in there. So you can see it was 116, and they have already been pushing and justifying that 124 for the expired leases that are coming due, and we'll continue to do that with the new property management. Another possible thing that we're going to talk about and probably do is adding parking spaces for some value add for some of the more premium spots to charge, a little bit to whoever wants to pay for those nice spots right in front of their units. And you can see on the right just a couple shots of some of the inside nice units. Trevor?
Oops, sorry, I went two. No, I didn't. There we go.
Go ahead, one more. There we go. All right, so here's a map overview of the area, and you can see, so buildings 1 through 5 are the older buildings that were built in 1985. That's 36 units, and the building in the back is the 24 unit that was built in 2004. Number 7 is a dog park right there. One of the things we're planning on doing in the next few years is building a playground for the families that live here and keeping the dog park, maybe moving the dog park to the front and putting the playground in the back so it's not too close to Cameron Road. But to the left of number 7, you can see there's a pool area that has been closed in, but this concrete slab is there. They put a little rinky-dink grill there. So what we're going to do in the next few years also is maybe put a grill with a picnic table, portico over top, just to kind of help people enjoy the summers and enjoy the neighborhood. Number 8 is actually a business center and law firm that's shared. Great people. Leonard and I met them when we were there. And number 9 is a medical center that's already been approved that's going to be coming soon. Right across the street, we love seeing this elementary school, and right next to the elementary school to the left is a middle school. So the families that live here, they get to walk their kids to school, and it's just we like to see that. So it's just a nice, safe area. And here are some of the classic units you can see before renovations. Nice, comfy, cozy units. Nothing too special, but still something that people would enjoy living in. And these are going to be the renovated units. So the property management said they did have 3 different companies doing the different renovations. So they do look a little different, but they still all look nice. And Leonard and I were there a couple weeks ago for the inspection, the due diligence inspection with Sanjay and Olivia. And we did walk every single unit with the inspectors. We stayed there for the 2 days and walked all the units, roofs, HVAC systems, pretty much everything from inside out. And there's nothing we didn't really expect that we didn't expect to see. So that's something that we really liked. So now we're going to get into some of the regional overview. So we'll just skim through this. 400,000 residents in the Fayetteville area. They do have a lot of historical sites, museums, galleries, restaurants, a lot of stuff going on in downtown Fayetteville, botanical gardens, a lot of festivals being held there. Fayetteville does have the heavy military presence and from Fort Bragg, and that's a total economic impact of over $8.1 billion. Nearly 265,000 military personnel, civilian employees, retirees, and their families are supported by Fort Bragg. So that makes this one of the largest military installations in the world. And it's not going anywhere because it's been there since 1918. And we love that, but we also love the fact that we just don't always focus on military and military families. There are a lot of other major industries in this metro area that include education, healthcare, retail trade, public administration, and some others that we're going to be showing you. I-95 corridor is right there. You can see 4.5 hours to Washington, D.C. and Baltimore, 7 to New York. Down south, you got 7.5 hours drive to Orlando, Florida, and a little bit further to Miami. We do have the largest deep water port of Wilmington is right there. Virginia's Norfolk is 3.5 hours away. And then to the southeast coast, we have the mountains. And on the right, just had some numbers on the scale for you. But this is going to be a map overview of the area. So you can see where we're at with in the dark blue. Up north, you have Raleigh, which is about an hour and 15-minute drive to the west. We have Charlotte, about an hour and 45-minute drive. And then you can see on the coast there, all the ports and the beaches. You got Myrtle Beach and all the other surrounding beaches. We just feel like we're positioned in a nice area. We're close enough to drive to the beach, but far enough that we don't have to deal with the weather and the other nonsense that they got to put up with there. So we're just in a really nice area and positioned here. So we are first in the cleanest air ozone for Fayetteville, number one job market in the country for college graduates, the number one for fastest growing city in North Carolina, which was pretty amazing when we found that out. Third fastest growing city in America, and then third best job markets in the nation are here in Fayetteville. And this is just some of the other employment that's in the area. We got Walmart 1.5 miles, Cape Fear Health System 4 miles, VA Hospital 6 miles, Fayetteville State University is right there, Amazon building, of course, they're everywhere. And then we got the Methodist University, and they're actually building a Cape Fear Valley Health School of Medicine in 2026. That's going to push some more employment in this area. You can see, of course, we got Fort Bragg here, and they also, to the right of that, you can see they're building a highway from Greensboro to Fayetteville for all the commuters. So that's we'd like to see that, cutting down on commute time. And Goodyear tires, everybody knows Goodyear's. We got a Goodyear plant there. And there's also a 500,000 square foot aerospace grade titanium mill being built in Cumberland County that's coming soon. That's going to have 300 new jobs in this area. So you can see downtown Fayetteville there. Me and Leonard cruise the area every time we're there. It's a nice, safe little area, safe little town. Right below that, Hope Mills Lake. We also stop by there. Families having picnics. They got ices and ice cream, and just a nice little area to hang out in. The Airborne and Special Ops Museum, Cape Fear Botanical Gardens that we mentioned, and then the baseball stadium there for some entertainment. And this is just going to be going over the employment numbers for what we just saw in the last few slides. The Fort Bragg, 63,000, Cape Fear Health System, 5,000, Walmart, 4,000 employees, Goodyear, 2,000, and so on. So nice, strong numbers other than military presence. Demographic and income profile report. All of these numbers are very important, and all these we look at, but we kind of mainly focus on the median household income and average household income. And you can see in a 5-mile radius, the average household income is $82,900, which is a nice, strong number that we like to see. And you can see it growing in 2029 to around 97,000. So just good, strong numbers to back up the business plan and what we have in mind here. And now we'll get into the rent comparables. And I'm going to go ahead and pass it off to Leonard.
Hey, thanks, Dave. So, so as far as this property is concerned, so this is one of the first things that we look. So, we took almost a year to look to get a good property, because we took 2 years to get Westwood, and Westwood is performing very, very well right now. We already did 4 distributions. Yeah, this month is going to be 4 distributions, quarterly distributions, and we closed last year of August. So that's the last so we did the last quarter distribution, and we have done 3 distributions this year. So we what we're looking here, we look at the market, we look at the job growth and the employment as well. And we had all that tick on our list. So another important thing was the rent comps. So we always like to go like what we always Dave and I always discuss, it's better to get a bad property in a good market and than to get a good property in a bad market, because you can always fix that property, fix the tenant, and you're gonna have a good your property is gonna perform. So we are having a rent delta for almost $200 to $500 as far as this property is concerned. Trevor, we can go down to the summary, and then I can, yeah, like right here. If you look at this property, like the first one, the Hidden Lake, that's a 216 unit built in 2004. That's the year our property was built as well. If you look at the square footage, the average square footage is 1,049. Ours is 1,050. And if you look at the rent there, the asking rent there are $1,659. And if you look us right down here, Woodland Ridge, we are still at $1,068. So there's a huge the market right there is $1,299. That's the market average. So we have that that gap, that delta, where we can go in and start increasing the rent. And we are not saying that we're just going to go in and bump the rent from $1,000 to $1,299. No, we are going to bump rent like gradually as the tenant lease comes to an end. Maybe $50, $75, $100 as their lease comes to an end, and then we try to take like maybe a year, 2 years to take it to market rent. So that is one of the opportunity that we saw on this property, and we're excited about it. Trevor, let's go. Thanks.
All right. Oh.
Yeah, so this is showing this is just showing the breakdown of the rent comps. Like we are right at the top, even though it says 2 bedroom 1 bath, but most of the units are 2 bedroom 2 bath. So we don't have any 1 bedroom right now. We have only 2 bedroom 2 bathrooms. And if you look at the properties below, like like same like the Hidden Lake, that's one of our comps that we are using that one because it's just like a couple of blocks across our property, just like half a mile drive, sorry. So if you look at that, they have their 2 bedroom and 2 bath, the same like at 1687, and even their 1 bedroom and 1 bath with less with 769 square footage, they are still renting that for 1273. That is the second line. So this is actually proof that the market is really a great market. And there's another thing about this market: the occupancy is 90%. It ranges between 95% to 100%. So we always look at that as well, because when you see a high occupancy in the market, it means that there's high demand for apartment in that area. So we don't want less than 90%. 80, 70%. No, we want 90+%, because as Dave said earlier, it's good for the lender. Next, please.
Yeah. And we have a bunch of these. We won't go through every property.
Right.
These are all in the deck if you go to the portal and download it.
Thanks. Yeah, this is just some of the comps that we use to justify our rents. So this is the older building, and the older building is they took care of the roof already. The current owner, he spent about $1 million, so he replaced the roof and work on the sidings as well. So he did a lot of capital expenditure on the property. We went there for physical due diligence, and the report came back and everything looks good. They just have some minor things for like that we have to take care of, maybe like the trees that we have to go in and take care of the trees, and some few landscaping. So yeah, this is the older building that was built in 1985. Next. So this is still this is the comparables, like the sales comparable. Can we go down to the next page where we have the numbers over there? Right. Yeah. So right here, if you look here, you see that the properties are selling for, like, it ranges between $131,000 to $170,000 per unit. But we are buying this property for $116 per unit. So right now, based on the value that the appraiser, or the value that they are looking at, is like its value at the appraiser came in at around 7.8 million. So we are already going in with almost $1 million of equity inside the value inside for the property. So which is a really good thing. So because we are buying at a very low price per unit. Okay, so yeah, so this is just showing the renovated unit. So we have 52 unit that have been renovated, and we have 8 unit that are non-renovated. So we have 4 which is vacant, and then 4 which is a vacant, 4 which is vacant leased, and 4 which is vacant and unleased. So we have one tenant here that have been here for 40 years. So since the property was built, he has been living in this property. So our one of our business plan is that we're going to go in. We just want to get this 4 unit. We just want to renovate this 4 unit first and have them ready for new tenants before we move into the other ones. When the tenant lease comes to an end, then we can renovate them and have them on market. Yeah, so this is the T12 and T3, which is one of the most important thing as far as our underwriting is concerned. But if you look at that, we are the property. One thing we always check on our properties or on our underwriting is that the property must cash flow day one. Cash flow means that the income minus the expenses, we have to be able to cash flow pay our have our NOI, pay our debt, and we still have some distributions to perform. So this actually marks that we don't go in with the projection that hey, we are going to raise rent before we will be able to cash flow. No, this property cash flow, like as we are talking right now, it cash flow, and then we still have those opportunity to increase the rent and to make more profit. So right now the NOI is 423, and our projection for year one, we are looking at $544 for NOI.
And one thing I just want to make sure I explain to everybody, a T12 is the trailing 12 months, but you often want a little bit narrower view, so you'll look at a T3 as well. So because things can change a lot, and so it's really good when you can look at both sets of numbers, because it gives you a realistic average. Because sometimes sellers will make a property look good for 3 months. You want the T12, and you just want to be able to look at all the different trends. So it's really good to have both of these details.
Yeah, let me add in there too. So so we always look for under market rents. We don't ever go in assuming that we can manage a property better, but that's also something that we look into. And we're going to be getting a new property management. We've already talked to Block Realty or Block Property Management, and they're going to be coming in. And if you can see right under the effective gross income, there's a $57,000 personnel charge right there that we are not going to consume, because we're going to start with a new property management company that knows this area. They love this area. They love this property. They were actually there with us during the physical due diligence. And so we still, down at the bottom, you see the property management fee of $45,000. That's around the cost that we're going to be paying the property management at 6%. So we are not consuming, right when we close this property, that $53,000 cost there, which is great for our underwriting.
Nice, thanks for that. So this is our projection for the next 5 years. Where our plan here is to it's a 5-year hold, and we always see based on the market. We can go ahead and refinance, and or we can sell based on the market. So we are looking at our gross income for the next 5 years to be $1 million, and our NOI to be $647,000. With this $647,000 at a 6 cap, we can be around $12 million as far as this deal is concerned. So, which is huge.
And again, I know these are overwhelming when you're looking at a slide. This is all uploaded to the portal, so I'm going to share the link at the end. All of the documents, all of this is up on the portal, so you can see it. And again, we can come back for any questions as you get going. So thank you, guys. This is my favorite slide. This is where we talk about you making money. So if you remember all of my other presentations, I talk about a 7% preferred. I want to make sure that I'm clear on what a 7% preferred means. If you invest until you make 7% on your money accumulated, David and Leonard and myself, we make no money, okay? Until you make your money. And again, I'm going to hop down a little bit down here in the return on cash. This is assume that you've invested $100,000. Roughly, we don't catch up until we sell. So we're not really making money until we sell, and we don't like that. So we're going to work really hard to make sure that we're making money, which means you'll make a little more money, right? So the way this works is you get paid first, and once you have accumulated a 7% return, we add it up. We don't start taking any of the split. So if you look here, the split is 70-30. So again, if you remember some of my other presentations, we're buying a property, we're financing it. So you're producing about 30% of the capital needed, but you're actually owning 70% of the asset, and you're going to be paid first before we get paid. So again, I want to make sure these are really, really important numbers for you to understand. The average cash on cash is 7%, which is what your preferred is. Our equity multiple is 2 times. And so basically you put the $100,000 in. This is what you would earn on an annual basis. So about $35,000 in cash flow and about $70,000 on your profits from the sale. So your $100,000 turns into 205. So we give you back your 100 and you're going to earn, and again, these are all projected numbers, another $105,000. As they mentioned, we are buying this at a 6.5 cap rate, and as the property performance improves and as interest rates decline, we're assuming an exit cap of 6%. For this particular opportunity, we are raising $3.2 million. And as we mentioned before, it is a 5-year hold. So again, very important for you to understand these numbers, that you get paid first. Then after that, we get paid our portion of the profits. Every dollar that's made, 70 cents gets sent to you as investors. And then once you're caught up, 30 cents of those dollars get sent to us. So I want to make sure that you really understand that this is an investor first approach, and this is what we always do. There's a lot of things that are happening. Thank goodness we got the big, beautiful bill back, and we will be doing a cost segregation study. So what this means is that you're going to get what we call passive losses from your real estate. Love them or hate them. When Donald Trump was talking with Hillary Clinton, he said he pays no taxes. This is how he pays no taxes. No surprise that this bill came back pretty quickly, because it is the real estate golden nugget. So what will happen is we'll do these studies, and on your thing, you will get a bonus depreciation. So you're going to roughly, on $100,000, you're going to get about $63,000 in passive losses. So again, I'm not your accountant or your financial advisor. If you are a real estate professional, you can use all of your passive losses. If you're a W-2 employee, you can use your passive losses against your real estate income. So again, once we start paying you some dividends, some spreads on this thing, you would have already have some passive losses in reserve. If you can't use them, don't worry. It's not a use it or lose it. It will stay there as accumulated loss until you use it all up. And again, you should be talking to your accountant if you want to understand this, but this is one of the most beautiful things about real estate investing, being able to get the passive losses. As always, we want to make sure we disclose all of the fees, so there's no surprises for you. So if you remember the 70-30 split, we're taking 30% of the profits of this particular opportunity. We do have a 2% asset management fee, and this provides for David and Leonard to be managing the property. This is a fee, and it's based on how much we have. The acquisition fee is 3%. That's paid on the purchase price. A disposition fee of 1.5, that's paid on the exit price. Okay, so we are paid a little bit when we buy the property, because it's a lot of work, it's a lot of risk, and we're paid a little bit at the end on the sale of the property. And then on any major CapEx budget, and I want to make sure this is all included in all of the numbers you've already been getting, so these aren't over and above charges, there is a 2% fee for managing any major CapEx projects. So again, we like to make sure that we disclose all of this. So again, if you remember, we're buying the property for $7 million. We're paying down the loan. We have our CapEx, our capital improvements. We have closing costs and acquisition fees. We have some operating reserves of a little over $100,000, which is where we get the 3.2 money. Now, this is where we're going to give you some really good news that we just got today. Okay, so we were originally financed at 6.5% with no interest only, and drum roll, what were you quoted today?
1 year of interest only and 6.45%.
All right, so interest rate went down a little bit, and we did manage to get 1 year interest only. So again, what that does is just improves the cash flow in year one. So it means that we're only paying interest instead of interest and principal. But the fact that it's a little bit better, it helps. It really does help. So again, the timing, right? So we're already October the 9th here. We're going to be in a final call by the end of this month for 506B. That means you don't want to be October 31st saying, Trevor, I'm in the deal. You're not going to be able to get all your paperwork done and get everything done, right? You want to make sure, listen, I'm interested. Let's start. Even if you're not going to invest or you're just thinking, book a call with me. Let's get talking about it, because the last thing we want to do is miss it. Secondly, if you're not an accredited investor, we're only allowed 35 people as non-accredited investors in the deal. So if a bunch of people get ahead of you in line and you're number 36, you're going to miss out. And again, if you're an accredited investor, don't think, okay, I've got the month of November, because you're going to save yourself some paperwork. So again, make sure that you take care of getting all of the information done. So again, this is a 506B. Because you're all big dogs, we have that existing relationship that works out to our favor. I'm going to put a link into the chat, and this link will take you to our cash flow portal. When you get onto the cash flow portal, that you are not making a commitment to invest. So you're going to fill out, create a profile. And again, your profile can be you personally. Your profile can be an LLC. Your profile can be your registered retirement funds, or we can change it when it's before we make your investment. Don't stress too much about that. Just if you're interested, get on the portal, start looking at the opportunity. All of the documents will be there for you to download. And just in case you didn't catch that code, you want to scan me there, and we've got all our good looking pictures. We do not do referral compensation. That breaks the SEC rules. That is against the law. Awesome. Any questions? I know we went through a lot of information. I'm going to put my contact info here again too. If you want to book a call with me, ask any questions. I know many of you on the call. I know we've been talking.
Trevor, you're posting Cedar Woods. I think that's a different opportunity.
Oh, did I really? Oh, shoot. Sorry. Don't click that link. Sorry, but good catch. Sorry about that. Let me get the right link.
I'll take that one too.
I am so sorry. How did I do that?
Yeah, we want to encourage everyone, if you are interested, to at least go and start your profile, because we are getting close to our soft commits that we had of like 1.4 are filling up. So we're just getting over 1 million now. So this is probably going to be filling up because it is cash flow in day one. Distributions are going to go out fairly soon. And then of course, the great tax benefits that are on. I think we might have.
I disappeared for a second. Wow. Sorry about that. Right. I'm glad I got back.
So I guess we can take some questions now, right, Trevor? If anyone's got any questions, we love questions.
I have a question.
Yeah.
Hi, I'm Sir Crystal. So I heard that you said that you can make what was it, 5,500 on year one.
That's at the 5.5% at $100,000 investment.
Yes.
Yeah. Yeah. So okay. That's what we're offering. Things could go better than that, and we could be, start out a little higher than that, but that's a very conservative a number that we're going to be starting at. And so you'd collect that 5,500 the first year if it did start out at 5.5%, and then throughout the 5 years it would exceed the 7% to average you out at 7% for those first 5 years.
Okay.
So you can see right there how it exceeds the 7% to average you out at 7% at the end of that 5 years. So you would have collected, based off of this $100,000 investment, $35,000 for those 5 years in passive income. Then we'd all talk, study the market, see where we're at, either refinance, pull out that equity, pay you back at least 70% of that 100,000. That's where that 70,000 comes from. And then you still have your initial 100,000 in equity into the deal. So if we refinanced, you would continue to get those distributions from year 6 to 10 where we would sell, or if everything's going right, refinance again, pay you back again at least 70% of that 100,000.
Okay, I like the last part. At least 70% of the 100,000. Yeah,
Awesome.
that's why I would be interested.
Sorry, I posted the right link this time. So sorry about that. Great question, though.
And this offering material that you put up here, this is all in the cash flow portal.
That is correct.
It's all part of that. Okay, great. I've never seen anything like this before. This looks very nice, extremely nice.
It's a nice project.
Thanks.
It's a very nice property. Excellent.
Might take us a while to find one, but when we do, it's going to be very lucrative for everyone involved.
For for Westwood, we actually promised a 5% because we're very conservative. Then we jumped into the property, and we did a lot the first year because we had a property management company that we did a cut on it, and we saved like $100K for the first year. And we were able to do distribution for, instead of 5, we did 7. So so like David said, you will always make your 7% throughout the 5 years, and it's a preferred return as well. So it's guaranteed that the investors get paid before the general partners get paid.
Awesome. Well, I was gonna ask. Yeah, go ahead.
Go ahead. I'm sorry.
Oh, you
I was going to ask. I saw for the marketing budget, you guys had 6,000. Is that conservative? Is that a conservative number for marketing?
So that's from the OM. We're actually going to leave that up to the new property management company. They're really good at marketing, and they already did the market analysis for us, and it's whatever they have budgeted. So that we kind of did our underwriting numbers with the OM numbers, and to give you a good estimation of where we're at with the in-place numbers and then the pro forma numbers as well. So if it needs to go up a little bit, that's fine, because we are saving that $57,000 from switching to the new property management company. So yeah, that was a good question and a good catch.
Yeah. Also, the new property management company, they are very huge in the area, and they have their advertisement. They have an advertisement platform that they also use. So they are going to do that. So that was low because the property was always above 90%. So they were not doing a lot of advertisement because it was right up above 90%. So anytime they turn the unit, they have a turnover, it's quickly leased. So they didn't spend a lot of money. So most of the time when you see high budget on advertisement, it means that there's a problem.
Yeah. Okay, McGanna, you have a question?
Yes, I just had a question on the depreciation. Can you just throw more light? When you said, you're going to get 60 something, right, percent on the depreciation. How does that really work?
So it's a passive loss. So when we give you your K1, it will show a passive loss on your K1.
But each year?
For the first year, correct. The majority of it comes in the first year, and then a little bit comes in the next 4 years. And then if you can't use it all, it doesn't go away. It can keep rolling over till you use it all.
Got it. Makes sense. Yeah. Okay.
It's a beautiful thing for commercial.
Yeah, it is. Absolutely. I can use it because I'm a realtor. So
awesome. Good for you. Well, this will be fantastic. This is the secret sauce of commercial real estate investing. So
yep.
Excellent.
Especially if you're a real estate professional, that helps out big time.
Yeah, it does. It does.
Yeah. So that we did have our cost seg team do that estimate for us. So that's a very close estimation of what it's going to be.
Thanks. Yeah, this sounds great. I think I have not seen, I've seen commercial projects, but this one, I love that, every 2 years when you refinance, you get that money back. That's awesome. I'm not seeing these kind of numbers. So yeah.
A funny story too. So when we were initially talking to the broker and underwriting, they came to us and they were like, so 8 of the units have been renovated and you guys are going to need to renovate 52 of the units. So we added $10,000 per unit for those 52 units. And then he came back to us and he was like, man, I'm so sorry. 52 of those units have already been renovated and are ready. And we were like, man, that's music to our ears. We love that. So it just totally switched up and just made the deal even better. And yeah, we're just really excited about it.
Yeah. No, thank you so much. This was great.
Okay,
And
well, thank you. Reach out to me, please, and book a call.
absolutely.
Okay? Awesome.
Yep.
Thank you. Thank you, everybody. Take care. See you in a little bit in the next one, David and Leonard.
Yep.
Right.
Thank you, everybody.